Welcome back. A recent Fannie Mae survey indicates from those respondents that the economy is on the wrong track, voted in by about 78% of all those surveyed. Only about 20% of those surveyed indicate the economy is on the right track. What we're referring to is a Fannie Mae Home Purchase Sentiment Index, the HPSI. And what it does is it's a composite index that tracks consumer housing related attitudes, intentions, and perceptions. It asks a number of questions in six different categories. Uh, of those, these are the most significant ones. Now, this is the HPSI year over year. It is up 14%, October to October of last year. But what we're going to see over here is the HPSI in white. Although it's up year over year, over the long term, going back to 2012, we see it we're at quite a weak level, only at around 65. This is on the scale of 0 to 100, and this survey started, way back around 2012. The red line's the S&P 500, and we can see over time there is a general positive correlation. When the HPSI sentiment index goes up, so does the stock market. Of course, both went to the downside in the 2020 COVID crisis, while the S&P 500 returned to the upside fueled by inflationary forces. The sentiment index certainly did not. We have come back, but notice how the S&P 500 at one point was very close to all-time highs. This survey was not. Among the questions that the survey asks includes, is it a good time or bad time to buy? A good time to buy is indicated by the black line. That's at less than 20%. Bad time to buy, that's up around 80%. Those respondents that indicate they don't know is in the purple line. It's very close to zero. There's virtually nobody out there that doesn't know whether they want to buy or sell. Is it a good time to sell? That is indicated by the black line. That's around 65%. Bad time to sell, that's in the 40s. So it's interesting to see if you put the two together. Is it a good time to buy, indicated by the black line? That's below 20%. Good time to sell, around 60%. The reason why perhaps the good time to sell line, the red line, is not higher. After all, if the black line's at 20, why is the red line not at 80? It's because very high interest rates are dissuading a lot of potential sellers. They don't want to sell because they know it's not a good time to buy. And if we sell one house, we may very well have to buy another. The white area chart in the background, that's the S&P 500. Again, this goes back to 2010. Black line in this case indicates our opinion. Will home prices go up? That's around 40%. Will home prices go down? That's around 25%. Will they stay the same? That's around 35% as well. So there actually is quite a bit of uncertainty out there. It's not like most of the market says it's a good, prices will go up or the prices will go down. And this is actually a very difficult, condition environment to navigate because most people really just don't know. Will mortgage rates go up? Black line indicates around 50%. Will mortgage rates go down? That's around 20%. Will they stay the same? That's around 40% as well. Well, will the Federal Reserve raise or lower interest rates? Of course, we can look at the Fed funds futures, which of course we do. But that only indicates what the futures market is telling us at the moment. Over the long term, will rates go up? It's very uncertain. It's based on CPI and non-farm payroll and all the other economic numbers we talk about, and there's just a lot of uncertainty out there. Here's the expectation of the percentage chance that home prices will change, as in that's in black, versus the expectation that rental prices will change. Now, the red line expectation of rental prices will change. There's a greater expectation that they will rise. Rental prices will rise as opposed to home prices. And that's not really a good situation because, for those of us that own homes, we'd like for home prices to go up because that's our probably our single largest financial investment. Will rental prices go up? That's a negative if that is the case, because that means for those of us renting, well, that certainly makes things more expensive. And that is a very large part of the inflationary measure we look at, CPI and PCE, those indicators. So this certainly is not a good situation where those of us that own homes, the expectation is that home is probably not going to go up in value. Those of us that are renting, our rent will or may very well go up. Is it difficult to get a mortgage? The red line indicates yes, and that's around 55%. Is it easy to get a mortgage? That's around 40%. So, and notice, by the way, since 2021 through present date, that has skyrocketed. Those that responded that said it's difficult to get a mortgage, well, if we overlay this with interest rates, we know where interest rates were in 2021, zero or very close to it. Well, that measure of is it difficult to get a mortgage? That went from 35 to 55% very, very quickly. Easy to get a mortgage, moved in the opposite direction and with the same speed as well. So we take a look at again, is the economy on the right track indicated by the black line, and that is down at the 20% level. The red line indicates if it's on the wrong track. And notice historically over time, as the white area chart in the background, the S&P 500 goes up, this tends to correlate well with a black line that the economy is on the right track. Of course, there was a major hiccup during the COVID stock market crash. But interestingly enough, since the COVID crisis, these lines have not returned to what we would expect them to be. Meaning, as the S&P 500 from 2010 through 2020 trended to the upside more or less very consistently, this black line did as well. We went from 30% up to around 50%. The red line is the economy on the wrong track fell from 80% down to as low as 30%. But the COVID crisis really kind of changed things. I think it was a lot of uncertainty, but then that was followed by a massive increase in interest rates that caused an inversion of the bond market in June of 22, which, by the way, notice how these lines really hit their peaks at the beginning of the inverted bond market. So it's really interesting to see how consumer sentiment, and this index is a very timely judge of of consumer sentiment. It literally is just a survey of our opinions out there as far as the expectation of housing prices and rental prices and future economic conditions. So it's very interesting to see. And the final chart that we're looking at right now is the economy on the right track or wrong track. That probably represents the greatest divergence of the indicators we've looked at. Very interesting to see. And we're going to continue to watch this very closely over time. We hope this has been helpful. We look forward to seeing you back soon.